Thank you very much, Vispi. Good afternoon, ladies and gentlemen. Sessions in afternoon, post-lunch going to be very interesting. The combined market experience of the people who are sitting on the stage is over 150 years. When I say the combined market experience, so Jamal is making a comment. We'll give a separate comment about the Jamal and green color later when I introduce Jamal McLeod to the audience. Deputy Governor Khan is unable to attend, so naturally whenever there is a risk management to be done immediately from the regulator, we go to the self-regulator. So self-regulatory organization, when we approached Mr. D.G. Patwardhan, who is the Chief Executive FEDI, so he readily agreed and he said, it will be my pleasure to come and address the audience. So the keynote address will be given by Mr. T.G. Patwardhan, who is the Chief Executive FEDI, and a short introduction of Mr. D.G. Patwardhan. And as most of you are aware, before I start that, I just wanted to say last year also, we had this same panel, post-lunch session, and there were heated comments made about the concerns on the current account deficit in the country. At that time, nobody was taking cognizance. Today, if you look at the papers or the financial dailies, at least there is an article every day on the current account deficit, or there is a mention about current account deficit, and there are concerns expressed across regulators as to how to contain this current account deficit. So that really goes to show the effectiveness of the speaker selection in this investment outlook seminar. What we really concentrate from the committee is whether we can add value to the participants who are coming and listening, spending their time with us, whether they will derive a rich experience from the experience of the speaker. So that's the purpose of this, the entire panel discussions, as you would have seen in the morning, and we are continuing with the post-lunch session. Mr. Dilip Gopal Patwardhan, presently the Chief Executive of FEDI for the last 2 years. As you are aware, FEDI was set up in 1950 as an association of banks dealing in foreign exchange in India as a self-regulatory body. Its major activity includes framing of rules governing the conduct of interbank foreign exchange business among banks vis-a-vis public, and liaison with RBI for reforms and development of forex market. Mr. Patwardhan is a postgraduate rank holder in mathematics, DFM, DIM, Fellow of Indian Institute of Banking and Finance, and member of Banking Commission ICC Paris. He has extensive experience of over 37 years in banking. He was the General Manager and CFO at Bank of India, and he retired as the Chief General Manager of State Bank of India, and presently the Chief Executive FEDI. And he will give an overview of the forex market and the regulatory developments to you now post-lunch session. Ladies and gentlemen, please put your hands together to welcome D.G. Patwardhan for the keynote address.
Good afternoon, ladies and gentlemen. Post-lunch session, so difficult session. On top of that, I am here replacing one, then another. Initially, I was not a panel member. Chairman of SBI was a panel member. I came in his place. Then DG didn't come, so I come in his place. So maybe the chief organizer of this function doesn't come, I'll come in his place. I don't know. Before we, at the outset, I would start with a little bit of a journey of Indian rupee vis-a-vis the foreign currencies. As a foreign exchange market, we typically talk about the foreign currency versus rupee. That's how we understand as a foreign exchange market largely. Out of that, again, 95% is a dollar versus rupee. So let's look at the rupee quickly as to what has happened in the past. As you are well aware, right from the beginning, that is 1947, since independence, India has been a member of IMF, and in those days, that is since 1945, December 1945, there was what is called as a fixed rate system, fixed exchange rate system, what is called as a Bretton Woods Agreement. So under Bretton Woods Agreement, the countries were expected to keep their currencies stable, fixed, moving only within a certain range, maybe 1%. So those were the days when the rupee was also moving within that given range. If any country wanted to make devaluation or revaluation, they had to have a discussion with the IMF, and only with the discussion and deliberations they would be given choice of devaluation, revaluation, what they require. So in this kind of a background, right from 1947 till 1966, rupee was fairly stable thanks to the foreign aid, thanks to the IMF loans, thanks to the soft loans. In those days also we face issues like current account deficit, trade deficit, so on and so forth, what we are seeing now. 66 was a major issue. Some of you may be aware, a day of 6/6/66. That was the day when rupee devalued by 57.56%, something which we can't imagine today. 57% devaluation, what can happen if it happens today? But I think we took it in stride at that point of time because we were largely dependent on the internal economy. We didn't have much of exposure to the external economy. So things proceeded. Came 1971, this Bretton Woods system which was there, it had a problem in all the countries, and suddenly one day, the then President of USA, Nixon, unilaterally announced delinking of dollar to gold. Till then the dollar gold parity used to be $35 to 1 troy ounce, and 1 troy ounce is about 31.1 gram. So roughly you can say $1 per gram, which is about 56 rupees per gram. Good, no? So, so they delinked, and Nixon did it without any dialogue with the IMF. So that event was largely called as a Nixon shock. And 71, the countries and the currencies started going on their own way. Every country adopted its own method of going forward. Some countries simply adopted US dollar as their currency. Some countries adopted full floating rate like Deutsche Mark, Japanese yen, sterling pound. Some countries chose a path which was midway managed currency. So rupee in those days was linked initially to sterling, then to dollar, then back to sterling, and then to the basket of currency. But it still remained as a managed currency. Came year 1991. In 1991, once again we were at the same crossroads, what was there in 60s and what is there today. Current account deficit, trade deficit. 91, many of you would be there at that point of time and would have experienced that. So 1st July 91, the currency was devalued by 11%, 12%. So people felt that okay, the devaluation shock has come, now everything will be alright. But they were proved wrong within 48 hours. 3rd July, another devaluation of 9%. And then thereafter, the currency was made more or less floating currency, where Reserve Bank of India intervenes if they find that the volatility is too large. But essentially, the rupee in current account transaction is left untouched by Reserve Bank of India by and large since then. Of course, there were some ups and downs in between, like in 92, what people were talking about a year back, a similar discussion was there in 92, that can we have a separate rate for the oil, for purchasing oil, for the dollar. Dollar rupee parity, different parity for oil and different parity for the other conversions. So perhaps at that point of time it was considered wise to do that. And then we had a dual rate policy. 60% of the dollars were converted at a floating rate, 40% of the dollars were converted at a fixed rate. So we experimented that for about a year and gave it up. So today perhaps if we have forgotten that, one must remember that, perhaps a lot of people remember that, and that is why dual rate so far at least has not come in. Came year 1993, and then there was some, not really change in the currency, but the way the quotations were given. You know, in the market, forex market, or for that matter any market, there is always some of the traditions, some of the conventions, some of the market practices. So there are typically market practices, how the quotes are given. Like for example, in 96 when I came to Bombay first, I used to stay in Andheri in those days, and there was a big market outside, vegetable market, not forex market. And I went there in the vegetable market first day and I asked, how is lady's fingers? Bindi kaisi hai? The fellow told me 16 rupees. I said, okay, give me 16 rupees worth. I got a kg of bindi and I came home. I went out of Bombay in 2000, came back again in 2006. Now I was staying somewhere else and I went to the vegetable market there. I asked, bhai, bindi kaisi hai? 16 rupees, saab. I said, yaar, badhiya hai Bombay. I said, de do yaar 16 rupees ki. He gave me only a quarter of a kg. Because the market tradition has changed. The market conventions have changed. Market practices have changed. So if you go to any other overseas centers, you will find the way the currencies are quoted. There can be different, one currency versus another currency, the other currency 100 units versus this currency, and all kinds of permutation combination. In India in 1993, FedI framed a rule that all foreign currencies will be quoted as a direct quotation, which means one foreign currency equal to so many rupees. This was one of the very user-friendly way of doing it, because until then we used to quote as 100 rupees equal to so many dollars, 100 rupees equal to so many Swiss franc. But from that day onwards, all direct quotations came. A few exceptions were some of the smaller currencies where denomination is large, like Japanese yen, Indonesian rupiah, Korean won. There we give quotation as 100 foreign currency equal to so many rupees. So for the last almost 20 years, this is working in India, and not working as a convention alone, but working as a rule. One of the user-friendly rule, you may say, which makes comparison very easy in the minds of a common man. And today perhaps Forex contributes 15% of our economy, and everybody knows about the foreign exchange rates. Everybody knows about how is dollar rupee. During interval, somebody was asking me a few questions about regulations. And somebody else said he may not know about the regulations, but he would definitely know what is dollar rupee rate. So that's the kind of spread the exchange rates which are understood by the common man today. And that is where we are at the present state. Now if you look at the foreign exchange market today, essentially the market is segmented into two parts. One is what we typically call as a OTC, over the counter, which are typically the bankers. So banks give the quotes for the various kinds of transaction, and the other market is you can call as a which is settled in cash, which is typically the exchanges in India. You have NSE, you have MCX, you have USE. These are the three exchanges which give, two of them give options, all three of them give future rates, and one can do a dealing there. But having said that, there is a vast difference between these two markets. As I said, one is by delivery, the other is by settlement, cash settlement. But beyond that, on one side, on the exchanges, one can do transactions very easily without much of documentation. However, you need to put in margins. You need to put in margin, you need to put in initial margin, you need to put in mark-to-market margin. So all that you need to do. But you don't have much of botheration about the documentation. You don't have to worry about underlying, you don't have to do the deliveries and all these things. So you have large amount of flexibility. On the other side, you have a OTC market, which is very tightly regulated by the regulator, where you can't do a forward contract unless you have something underlying there. You can't do a foreign exchange just for the sake of doing it. Of course, now on that part also, Reserve Bank has liberalized a lot of things. Like personally, you can invest $25,000 up to amount that anywhere without any approval, without getting into any procedural part. But leaving aside the small amounts, any large investment, any large transactions, it has to go through the various regulatory processes. You have to comply with the various laws. You have to comply typically with the FEMA regulations. You have to comply with the other regulations of the RBI, FEDA, etc. Typically, if you are a very large corporate, you can do business with based on the past performance, but then you have to spend a lot of money for the compliances which relate to the auditor certificate, this and that. If you are doing it based on the underlying, you have to produce those underlyings. You have to be, the banker has to be satisfied that what you are doing is appropriate for you, because you know the issues which raised in 2007 and 8, where some kind of covers which were not really required were taken and sold and all kinds of things. So with that, perhaps Reserve Bank of India made the regulation a little tight. Some people may object to that who is Reserve Bank of India to tell me how should I do it? Well, the law tells you also that you should wear a helmet. It's in your own safety. But law is required to tell you that you should wear it, because perhaps we don't understand our own safety. So a regulator is required to tell you as to how to go about while you do the forex business. But at the same time, if you go to the other side, which is exchange, and if you have margin to give, you can do some of the things very quickly and without much of paperwork which is involved in that. From 91 to 2013 now, where the market has evolved fairly, the market has become fairly deep. The turnovers have increased. Today perhaps the volumes on the OTC market and exchanges both put together, average volumes are about something like $30 billion. And the peak volumes are something like $50 to $60 billion per day. So with those kind of volumes, the liquidity is not an issue. If you want to unwind a position which is fairly straightforward or a, what they call vanilla position, it's very easy and very effective way of unwinding, effective way of getting out. They are there. There are some discussions on the third market, which we don't recognize in India officially, which is the India market, which works in places like Dubai. At times people say that that market also reflects on the ports in India, but we in India, at least the regulators, we don't recognize that that affects, because we say there is no delivery there and it's essentially speculative market. There is one aspect which we all always have in mind, at the back of our mind, that too much of speculation is not good for the market or not good for the participants. There cannot be totally zero speculation, because speculators are required. Speculations have their place in finding the price, the right price. But perhaps the excessive speculation, which is now the Western world is also realizing and trying to ring fence the banking activity, because too much of speculation is affecting their bankers as well. So perhaps the regulators here have proved right in this crisis kind of situation that some amount of moderation, some amount of restriction is good for the forex market, and that is where the regulations really stem from. One of the underlying thread in all the regulations of Reserve Bank of India or for FedI is always relates to the suitability and appropriateness of the products, whether it's a forex product or whether it's a vanilla product or a very structured product or whatever it is. The product should be really appropriate for the customer, and that is where the responsibility of the banker comes in, to ensure that the product is appropriate and product is need based, and it has some built-in mechanism which will protect the customer in the worst kind of situation. So that kind of a care the banker is expected to take. Having put that in place, then there are some amount of flexibility which are given, like for an exporter, he can cancel some of the contracts up to the extent of 25% and rebook them again. But the total freedom of cancellation, rebooking, etc., the regulator doesn't give. So one has to work in that framework which the regulator provides. But when it comes to the SMEs or when it comes to the individuals, there are far lesser requirement, though the basic principle still is there, that appropriateness and usefulness of the product. But the SMEs and the individuals are not required to undergo the same kind of documentation or the same kind of paperwork. There is far more ease in the operations. The only care the bank has to take is that there is a banker-customer relationship, and bank is fairly satisfied about the capacity of that customer to deal with that kind of a transaction, and the transaction is really required by him. For example, for an individual, up to 100,000 equivalent dollars, even you and me can do a transaction, provided our banker is satisfied that we are capable of delivering the counter currency. So largely it is left to our own operation in the account, and bank being satisfied that you have adequate capacity to deal with that kind of a money. For SME, it is linked to the credit exposure that a SME has, and SME has a fairly free hand to do the hedging. But at the end of the day, SME as well as the counterparty bank has to keep in mind that it is hedging and not speculation. Speculation is certainly not what is desirable for this kind of segment. And if you really go over the board, we have seen what happened in some of the SMEs and some of the smaller companies which took excessive hedging or excessive forex operations. Other than RBI rules, there are very little really regulation which we have today. FEDA has a few regulations which says the general things which are common sense things, like the contract cannot be for more than a month spread. A contract is allowed to be delivered early or rolled over or extended, or the brokers or the intermediaries who are in the market should be the recognized intermediaries, or the interbank settlement if there are any issues, how to resolve those issues. So there are very few regulations which FEDI provides in these markets. This is essentially the regulation framework which I thought that I will deal with in this address. And thank you very much for patiently hearing me. Thank you.
Thank you very much, sir, for running us through the history of the Indian foreign exchange market. Our next speaker is Mr. V. Tyagarajan. He is well known as Tyaguji in the forex market. He was with us in the last year seminar also, and the response we got from the participants, the feedback was excellent. So that's why we have extended him an invitation again. And he's currently the senior most US dollar INR trader in the country with an experience of more than 18 years, where longevity is synonymous with consistent success and the singularly strong ability to adopt different market conditions. So he has seen the direct rate, indirect rate, and the LERMs, modified LERMs, and the whatever the markets we have seen post 2008. And in 2000, he began his career with Syndicate Bank and was the chief dealer in charge of forex treasury, after having had a long stint in the Syndicate Bank office in London. And in 2003, he moved to Reliance Industries as senior forex dealer, and since then, he had risen to being in charge of forex treasury and currently working as a senior vice president. All of us are aware that the Reliance Industries merchant volume is close to US dollar 500 billion, and they handle almost close to 15% of the country's total merchandise external trade. Having said this, there is a caveat. All the views that are expressed by Tyagarajan in this seminar will be his personal views and not the views of the companies that he represents. Tyagarajan will give a global perspective of the currency market with a brief coverage on the US economy and where the US dollar is headed. He will also touch upon the domestic scenario impacting the INR. Ladies and gentlemen, Tyagarajan from Reliance.
Thanks, Venkat. Good afternoon, ladies and gentlemen. It has been a pleasure and privilege for me to be associated with this seminar for the second time running. Naturally, my limited objective is to talk about the global macros as well as Indian macros in flat 10 minutes, I believe. Venkat, you will give 10 minutes or? Okay, fair enough. I think the enormity of task and the limited time, naturally, I'll have to do some somersaults. Anyway, see, basically the theme of the year, or possibly the theme of the global financial markets has been, my papa is strongest, as simple as this. Whether it is a Bernanke, whether it is a Draghi, or whether it is a Abe, or closer home, whether it is our own finance minister. We all know what are the problems and we think our papa is strongest. So, coming back to actually basically the global economy, I say basically global economy, let us put it like this, possibly to understand it much better. After the crisis, 2010 and 11, the emerging markets led the growth. The developed markets were just limping. And then from 2012 and possibly 2013, it's going to be the year of possibly US and emerging markets all along, possibly everybody included. Let it be the BRICS or let other emerging markets like Asia. All are going to be somewhat having a sluggish growth, as simple as this. So for now, US is going to lead the global growth, possibly 2013 and possibly 2014. So if the global growth is going to be led by US, naturally the dollar is going to be stronger, as simple as this. Now the only thing that is keeping the dollar on the back foot is the quantitative easing that is running. But you just see there were two reasons for the entire miss to happen. What were the two reasons? One was the labor market and another was the housing market. The labor market has been recovering fast and the housing market is also recovering fast. But the quantitative easing is still continuing. It is actually basically the debate has begun when they will exit QE. So naturally, if the growth differentials are going to favor a particular currency, naturally dollar is going to be the king. With 10-year yield possibly going up to 275, naturally dollar is going to be much stronger than you can think. Possibly I may even say to the extent thus the remaining part of this decade belongs to dollar, as simple as this. That. Coming back to Europe, of course, you hear about all these smaller countries coming to the center stage. If it is a question of Cyprus, tomorrow it could be a question of Estonia or a Slovenia or a Malta or a Luxembourg. Only when the crisis happens, you know that such a country existed. As simple as this. So Europe, the growth is going to be pretty sluggish, and actually possibly it is going to be contracting. Eurozone economy is going to contracting, and the peripheries are not doing well, and Germany is the engine of growth as far as Europe is concerned. If the periphery doesn't do well, Germany doesn't do well. If the emerging markets doesn't do well, naturally Germany doesn't do well. So naturally, if the China or a India or a Russia, they don't do well, naturally Germany doesn't do well. Because at the end of it, Germany is the manufacturer of the entire world. If unless China constructs some bridges and India constructs some plants, naturally there is not going to be demand for German machinery. As simple as this. So, at the end of it, the Europe is going to contract and possibly contract by 1%. Yes. And then on the other hand, you have a Japan and China. Japan, maybe the new economics, actually they have found some sort of a way to come out of the deflation and possibly achieve an inflation of around 2%. Naturally, that could happen. Basically, the credibility of the BOJ has been increasing, and of course, come Thursday, we will come to know what exactly is going to happen, as simple as this. And China, possibly I think the days of 9% growth are over, or 10% growth are over. Possibly I think we will struggle around 7.5% growth. So, the rest of the Asia, for that matter, it's going to be a bit difficult, because basically, with the Eurozone is contracting and the rest of the world is going in multi-speed recovery happening in the rest of the world, naturally Asia is going to be very difficult actually. Asia is going to be very difficult, and possibly people who have recommended Dollar Asia short stories in the beginning of the year, I think possibly they are all unwinding. So as we see, actually Dollar Asia upside is very much there. And coming closer to India, this is basically what, of course, we talked about the current account deficit. Of course, last year also we were talking about the current account deficit. When we were mentioning about $85 billion of current account deficit, nobody believed. Now, possibly, if 2014 we are going to end with a figure of 100 billion current account deficit, nobody is going to believe. See, strictly speaking, because of the limitation of time, let us restrict our talk only to the current account deficit. In simple economic terms, current account deficit is nothing but investment savings gap. Investment minus savings is equal to current account deficit. As simple as this. So, when the investment is not happening and the savings, the gross national financial savings is going down, private sector as well as the public sector, that is, when you are running up a high fiscal deficit, naturally you are going to run a high current account deficit. So, even at let's say 5.3, 5.2 or a 4.9, all these numbers, naturally you are going to have a current account deficit which is going to be in the region of at least $100 billion. You just look around you, and what is the one item which has not been imported? You just see. Whatever that we use, right from your mobiles to shirts to pants to everything, we all use foreign goods. As simple as this. The broomstick that you are buying in Big Bazaar is an imported item. As simple as this. That means Indian manufacturing sector is not having the competitiveness to serve the growing consumption in India. As simple as this. The capacities have not been built for the last 5 years. Now, naturally, there is a demand arising on account of the consumption, which the domestic private sector is not able to address. So, as long as the dollar rupee is going to be like this, the imports are going to grow further. How to address the current account deficit? A, whether you can compress the current account deficit, or you have to accelerate the capital flows to balance the current account deficit. Now, what we are doing, we are accelerating the capital account flows. Fair enough. But when you are accelerating the capital account flows, this is going to be bringing a vicious circle. Vicious circle in the sense, as we are confident, now right now actually people are talking, after printing 32.7 billion current account deficit in the third quarter, the dollar rupee has not moved in the last 2 days. Naturally, it should have resulted in a panic reaction, but market is not moving. Why? The basic thing is, now we are all confident, our papa is strongest. We will bring in capital account flows. As simple as this. So, when you know that capital account flows windows are going to be opened up, naturally the current account deficit is going to grow much higher. If the current account deficit, by current account deficit, what you are trying to do, basically, we are exporting our demand. We are exporting our jobs. As simple as this. Any country which runs a current account deficit, naturally, it exports the jobs. So, if you are going to address the manufacturing sector of India, naturally, what you have to do, the current account, yeah, fair enough. Okay, fair enough. There's only last 2 minutes. Naturally, the current account deficit has to be compressed instead of arranging for capital account windows. As simple as this. If you are trying to go open the capital account windows, naturally the current account deficit is going to rise and the manufacturing sector is not going to grow. So, if the current account deficit is going to continue like this, let's say $100 billion when we touch in 2014, naturally our growth rate will not go past 5%, especially our manufacturing sector. So, actually we are playing with fire, as simple as this. At about $85 billion current account deficit and at about $212 billion of trade deficit, which is expected for 12-13, we are holding the largest, second largest trade deficit in the world, second largest current account deficit in the world. It is frightening macros. We have to be very careful as far as actually possibly the complacency in the market as far as dollar rupee is concerned. Naturally, it hits a peak. And then when the complacency is at the peak, then naturally the up move starts as far as dollar rupee is concerned. Last time when we were addressing this same gathering, dollar rupee was at about 51.5 type. And people are actually, somebody was showing the slide, it should be between 51 and 53 type. And then within 3 months, we saw 57.33 getting printed. Hopefully, that's about the macros. The current account deficit has to be addressed in a more convincing manner where you compress the current account deficit rather than accelerating the capital account flows to address the current account deficit. So, as far as India is concerned, this is the biggest problem. This is the biggest problem, more than the fiscal deficit, more than any other thing. This current account deficit is a major problem. So, summing up, actually you are going to see a stronger dollar against the majors, stronger dollar against the Asians, and possibly a stronger dollar against the rupee too. Thank you very much.
Thank you, Tagu. In summation, 2013 is a year of dollar, contraction in Europe, new economics in Japan, and a triple-digit current account deficit. All of you be guarded. The next speaker is Brijgopal Jaju. He is the Director and CFO of Welspun Corporation Limited. And I just called him 4 days back that we require an immediate speaker who has handled both the trade flows and the foreign currency borrowing. He readily agreed thanks to Jamal's reference. And one uniqueness with Mr. Jaju is that he is the only individual today to have got 4 times the illustrious national award as the best performing CFO. That speaks volumes of how he has been managing the exposures in the company, both domestic and foreign. And he got cornered over 200 times for significant contributions made as a key speaker and chairperson for prestigious workshops. So we have rightly chosen you, sir. One thing what impressed me when I read his profile was that his passion includes that he is a magician. So now I know how he makes money for the company. Over to you, Mr. Jaju, to give a perspective on how you have been managing the exposures. Sorry, you have only 600 seconds.
Oh, that's great. Thank you, Mr. Venkat, raising the bar of expectation for me. Very considered, learned panelist speaker and august gathering. And I am facing most intelligentsia or who control more than 70% of market cap of this country. I hope to make some contribution through this forum. Just bear me out. What I will confine is, friends, what in real life as a corporate, particularly which I have worked for and I have closely witnessed, the basically problems which were encountered on this forex related issue. But let me get back to one basic concept and most concept which always keep talking is about the finance management. And for me also finance concept got evolved over my 37 years of working experience with large corporates. Earlier, because in India we were just working in a protected economy and naturally we were not exposed to that competition of outside India, be of a trade related or capital raising related. So focus was always, finance concept was raise our revenue. The growth was always turned how much sales we have garnered. Everything has become now concept of vanity. Then the concept changed with lot of, focus came on, let us create a earning potential. So the focus has gone straight to bottom line. And then through cost reduction measures, through productivity enhancement, through, all kind of how best you can earn the operating margins. But that also proved to be a sanity, not necessarily that profit was finally found in the banks. So immediately, the last quarter or last decade, the focus has come on interesting buzzword called free cash flow. And then your organizational performance is now measured how much have you created a free cash flow in the organization. Looks very much reality. So I have called vanity, sanity and reality. But my dear friends, now with the kind of exposed to multi-geographies, the kind of business dynamics which have changed, the customers' expectations have changed, preferences have changed, and the kind of global turmoil which is happening in terms of complete economic volatility and managing uncertainties. If we don't address those uncertainties, if don't manage those contingencies and high-profile risks, everything can prove fatality. So now the new concept of finance is more around how do you manage those uncertainties. But before I take even Forex as a risk mitigation is a very simple for me to talk. But have you ever thought of umbrella risks which are on this Forex working? In every organization. Let me just take a pause and explain you what I mean for this. There are 4 fundamental risks. And these risks are according to my concept, which I have borrowed this concept from some other author's book. One is denial. We tend to deny as a working executive that we don't do any speculation within our company. And speculation here I mean on a Forex things, confined to this topic. We deny that we have a required hedging practices and policies. We always tend to show kind of things we are the best in sitting our seat. Added to that, second risk is in terms of arrogance. The best of the suggestions and recommendations given even by outside consultants sometimes are brushed aside. Sorry to say. Mr. Jamal must be working hard with large corporates and sometimes some organizations, because of that basic arrogance, believe that what we are doing, we are smarter than all others. So that's another arrogance is a major risk. And third is complacency, because in past we have seen all that cream because we were insulated from those vagaries of uncertainties. And so that's why complacency has come. And result is you have seen a lot of organizations have lost or destroyed the value. And last is the greed obsession. Every time we try to justify, devoid of fundamentals and economic basics, that whatever we are doing are right things. And every chain, an underlying asset is just 1%, and on that you leverage 20%, 30%, and every time financial professionals and respected external fraternity try to justify, everything is earning chain. Now let's not forget these 4 fundamental risks. Okay, which I again say is that denial factor, arrogance factor, complacency factor and greed factor. Now let me say that why I said this. Today we work in an organization where predictability of the profits and cash flow has become a major challenge to any CFO. So it is imperative for us to deploy a right risk management strategies, and this strategy is a right initiative for profit and value enhancement purposes. So basic, you always think of financial tools, which generally we say that with reference to what kind of equity and debt point of view. Another financial tool could be conventional form of insurance. Maybe it could be by way of raising convertible bonds. Maybe it is like financial instruments in form of forwards, futures, swaps, options, and those are the kind of financial tools. Are they good enough to take care, address your profit, that's volatility factor, be it a forex rate or interest rate or commodity price or any other volatility? Answer is no. You have to have a blend and right mix between financial and other real conventional options. What are they? And this I am always saying out of our real life experiences. You have to see that, is there something way out you can pass through that kind of exposure to your ultimate customer? If there's something like contract can be worded then you don't have to get into this because everything is passed through. Is there something like market pass through? If everything moves up and down with reference to say dollar, your commodity, particularly say like steel, in the local market will also move in tandem with the dollar and INR. Then you don't have to take that other so-called exotic hedge or plain vanilla hedge also. Third is that agreement may contain, I am seriously constrained, but somehow I'll try to wrap up in 2 minutes, I'm sure, and with extension of another 2 minutes maybe.
It's a denial risk. It's a denial risk.
Sorry
of
sir,
your-
I'll respect to this. So basically, one has to also think of that other real options and blend of that. And I will have to really rush very hard, and the pressure has come on me. This is really big risk management for me to handle now. In this forex policy, what is another next item is a hedging approach and hedging practices. One of the philosophy religiously as a religion, one should say that I will not take hedge for which there is no underlying asset. So I have to have first of all asset to hedge on this whole thing. And the underlying is what? Your commercial transaction. Then basically the approach goes like that. Your internal system has to be robust enough whereby you are able to recognize, identify which are the exposures. Exposures on account of your trade, imports or exports, or other related payments, maybe shipping freight outside, commission payment outside, professional fee outside, royalty payments received or outside. So those are the kind of operational related exposures. Your system, if divisional head is there, he should be immediately able to recognize and feed in that exposure to maybe centralized treasury. Number 2 exposure is basically this forex loans, which we have taken in forex, FCCB, ECB and other foreign currency loans. Now that central treasury immediately must recognize when it crystallizes, it should enter into his book of total things. After recognition of the exposures and intimation, then question is of the hedges taken. How much has to be taken? Something you consider natural hedge. If there is export, there is import, it is cancels out. Natural hedge, what is the balance value added? You need to take a proper hedge. My dear friends, I must caution to you at the cost of lot of bankers sitting over here. Don't get into the trap of these exotic hedges which you don't understand. They look nice, collars, caps, this, that, which, what happens without understanding? If you get into trap of that, you don't know how to exit out of that. It becomes that like Abhimanyu Chakravyuh. You understood only up to 90%, but you don't know how to come out of that. So, plain vanilla forwards, plain vanilla options, which definitely serve the purpose of this hedging exercise. Please don't put pressure on your treasury setup to make profit. This can never be a profit-making activity. The focus should not be on profit making. Let profits come out of your normal products and services if that products have some kind of marketing capabilities, but not the hedging tool. Hedging should serve purpose to protect your cash flow. Hedging should protect your forex volatility. And that is the value added service that should be the scene of treasury function. I am just quickly now running. Can I have 1 minute? Thing is, all this manually not possible. Because the point of now exposure when organization has stepped out from India, a lot of multi-company setup, subsidiaries, you don't know frankly when the exposure is coming. At the time of bid it comes, at the time of contract it comes. So it has to be automated. You have to have some enabled tool, IT tool to tell you when the exposure has begun. And last, which I will tell you only some challenges, just 2 major challenges I will tell you. Lot of investments are going outside, but you don't know how to protect that from hedging point of view. Some of the raising funds like FCCB and long-term forex loans, you don't know how to protect that. In my concluding remark, and please rest be assured, I thought I will get 40 minutes. But concluding remarks I must share with you is that point number 1, please see that there is underlying asset for which you are taking hedge. Your risk policy should be aligned with corporate strategy. It should not be in deviation to that. Number 3, you must know the limits of hedges. Hedges is not like Ramban or Panacea which will take care of everything. You must have blend for financial tool and real life tools. Don't put pressure on your treasury to make profit out of that. Let them work according to the best principles of hedging. And last, please learn to see each time is that hedging making a sense, or sometimes self-hedging also can be a better option, because sometimes cost of hedging can be a prohibitive. With this note, thank you very much, and I could do something out of my cost. Thank you.
Thank you very much, Jaju. I think you can straight away walk into any regulator's office because you got 2 special class from the regulator when you were making your observations. It was a pleasure listening to you. The next speaker is a colorful speaker, repeat performance. Wednesday is the color of green for him. So green is the symbol of nature and life. Plato, the philosopher, has said, a good decision is based on knowledge and not on numbers. So having heard the 2 people managing the treasuries, one view on where the dollar is headed and another view on the cautious optimism. Now over to Jamal. Jamal advises most of the companies, big, medium, small, and whatever size it is. So over to you, Jamal, to make a colorful view of the rupee and where the dollar is headed.
Thank you, sir. Thank you, Venkat. You commented on my green shirt, but not on my tie. I wore this tie for you, especially. Now, I'm actually extremely disappointed that Mr. Khan is not here. He was supposed to be here, and Venkat told me that he's with the finance minister. That is actually not true. He's not here because he knew I'm going to be here. He's a good friend of mine, and I make it a point always to embarrass him when we are in public forum. He enjoys it. So I will, even though he's not here, but it'll come along later, Now, I'd also, I'd like to pick up on what Thiagu said, because frankly, I agree with him virtually 100%. I think the situation right now, first talking about the dollar globally, for over a year, actually for 2 years, I've been expecting the dollar to get very, very strong. And it sort of tweaked in my mind, I think it was February 2011, when the dollar fell below 1 Australian dollar. Now, like you said, things, numbers will take you so far, but sometimes you have to live based on what makes sense. Now, to me, an Australian dollar being stronger than a US dollar just doesn't make sense. And of course, that was 2 years ago. The market can stay irrational a lot longer than you can stay solvent. But the reality was that for me, that was the trigger when I knew the dollar is going to rise. It had been falling for 10 years. Now, it's taken a couple of years. It's come up a little bit. But I think it's now at a point where it could really break out. In particular, if you look, I'm not a technical analyst, but I look at a lot of charts. If you look at gold and you look at copper, both of these are poised to really fall sharply. So now it may not happen tomorrow, it may take some time. So I feel it's very clear to me, and I'm really happy that Thiago agrees with me, because he's a very sharp guy, that the dollar is really going to rocket higher, right? Globally. And I'm curious, you said the decade could be the decade of the dollar. I certainly feel that may also be true. The other very important point that he made, which is pretty common knowledge now, is the current account deficit. Now, if you look at the papers, you talk to anybody, right? Everybody's saying, my God, the current account deficit is out of control. And just bringing in money any which way to fix it is not fixing the problem, right? I mean, we are not, what is the solution? What is the solution? Nobody really knows, right? And also we have a government that is, tied in knots. It really can't do a whole lot. So, I mean, the big question is, why isn't the rupee at 58 already, right? Everybody in the world believes that the current account deficit is not fixable in the next 12, 18, 24 months. So why is the rupee not falling, right? If everybody, because, now, to my mind, there's one other thing I've learned from being in markets a long time. I've said this before, I may even have said it at this forum. The job of markets is to make hundreds, millions of very smart people look like fools. So that is the job of the markets. And that, I always say the market is like God. You're not smarter than God. So what happens? Now, we're all very smart. We're looking at current account deficit. Dekho, ye dekho, wo dekho. Everybody is moving in the direction that rupee should weaken, right? And normally what would happen is when the vast majority of people are looking in that direction, the market goes the other way. I mean, we've all seen it, right? But till now, really, till about last year, I was the guy who never went that way. So maybe because I was always optimistic, it never really turned around very sharply. But now, I'm sad to say, I'm becoming pessimistic. And sort of the last optimist has turned the other way. But still the rupee is not falling, right? The only thing I can think of, right, is that because RBI, here's my friend Mr. Khan, has put real clamps on the market, right? Since, again, December 2011, the market is very thin, very narrow. It really cannot move freely. So on the one hand, really what should happen if we had a more open and freer market, under this huge sentiment that the current account deficit is insoluble, the rupee should really be falling sharply and then reach a point where it would turn around, right? And start coming back and perhaps ultimately even strengthening beyond this level. I mean, I would love it because I make money when the markets are more volatile, but kya kare, you know? So I feel right now the situation is very, very precarious. It's very difficult, very dangerous for companies. You know, we help companies to manage risk. And I feel that some of the big problems, you know, are today, if let us say you've got a foreign currency loan, you know, or you're an importer. These are the people who are in danger. The premiums are quite high. You have to pay, you know, 3 rupees to cover 1 year forward. The rupee is 55 today and you've got a 5-year loan. 3 rupees a year means you're buying dollars at 70 rupees for 5 years forward. Who would do that, right? So as a result, nobody does that, right? So as a result, there is this continuing load of short positions in the market. It's not going to go to 70, I don't think. I mean, I don't know, but it does, so why should I buy today? But then sometimes what happens is you get a little blip, it goes up to 57, you know, maybe comes back, and, you know, your balance sheet gets wrecked in the near term. So what is needed is, and here I will disagree with my friend Mr. Jaju, is that companies need to sensibly use hedging instruments, which may not be just straightforward. By far and away, the best instruments are plain vanilla options. Problem with them is you've got to put a lot of money on the table, right? What happened 5-6 years ago is people went from that saying, I want to hedge, but I don't want to pay anything, right? So people bought all kinds of zero-cost structures, which ended up in tears. I mean, if there is zero cost, there is only one thing certain, that there is hidden risk. So zero cost is not the answer. Plain vanilla options are very costly, so there is an intermediate tool which is very, very useful, which is called a call spread, where it, again, doesn't protect you 100%, but it enables you to hedge yourself against really a bad move of the rupee downwards. Now, one of the problems, and here again RBI comes into the picture, RBI requires a company to have a 200 crore net worth to buy a call spread. Now, there are dozens, not dozens, hundreds, thousands of companies who don't have a 200 crore net worth, but who have risk. Now, on the one hand, RBI and the government are carrying on that they want inclusive growth. They want to work for, help SMEs. But they have certain regulations which have been in place for a long, long time. And like I said, I've said this to Mr. Khan directly, and, you know, I'm mentioning it again here, because I think these are the kinds of things that the central bank needs to do. You understand it's a precarious situation. Nobody really knows what's going to happen. You really need to be able to take care. But, you know, SMEs' hands are tied because they are not allowed to buy call spreads. I have a client I was talking to yesterday. I told him I'll mention him when I came here. He has about 35 million a year of imports, right? And he's, and you know, he doesn't want to pay the full premium. He'd be very happy to buy a call spread, but his net worth is maybe 110 crores or something like that. So this is sort of one of the changes that needs to be made. And just to touch on the point of SMEs, you know, because again, SMEs are the heart and lifeblood, not just of India, but of most economies. Most of the business in the world is done by SMEs. And yet, unfortunately, SMEs are very ill-served, not just by regulation, but also by the fact that, you know, everyone's in business to make money. And if you don't have clear, direct information, it's very easy for banks, sorry Ashish, who are in the market to, I mean, they're there to make money. And if you are not properly informed, you are going to lose at the margin. And this is not just true of SMEs, this is true of much larger companies because the markets are so volatile. I mean, if you have agreed that the bank is only going to charge you 2 paisa or 3 paisa from Interbank. But the reality is you don't know what Interbank is because the market is so volatile. Reuters doesn't give you Interbank. Only Reuters Dealing will give you Interbank. So there needs to be a lot of technology brought into the market specifically to try to support everyone, but SMEs in particular. I could go on, as you know, but I have to go. And thank you very much.
Thank you, Jamal. You made a very valid point because SMEs who contribute close to around 9% of country's GDP and 40% of country's exports should actually deserve. Collect your memento. And
Mr. Venkat, 1 second before he leaves. Mr. Jamal, I need to offer one clarification. What I meant is the hedging complicated instruments which are not properly understood, please avoid that. I did not make any comment on your so-called sophisticated products. As long as corporates have understood, please, they are free to do that.
Big round of applause for Jamal. He is leaving us now. The next speaker is a banker. I have always believed what Ashish does not know about market is not worth knowing, because his bank always produces 30% profit than the last quarter. Not for the past 30 quarters they have been doing that. So it's outstanding and amazing. So Ashish Parthasari holds a bachelor's degree in engineering from Karnataka Regional Engineering College and a postgraduate diploma from IIM Bangalore. And he'll give a banker's perspective, because we have heard two corporate treasurers speaking on the markets and the consultant who is guiding the corporates. Now, as a market maker, he provides the price support to the corporates, and he interacts with the consultant, and he trades on his own account. And over to you, Ashish, for giving a banker's perspective.
Thank you, Venkat, and good afternoon, ladies and gentlemen. I will refrain from giving any views, because I don't disagree with the views already expressed by my co-panelists. So I think that's something which I can avoid. Though, I may have a question for Thawood after this, depending what. What I want to say is, what most speakers have said and what we are all aware of is that we are living in an era where the volatility of exchange rates is high. Now, if you just for illustration, if you take the dollar rupee, if you take the last 3 years, I am just taking figures for the last 3 financial years. If you say financial year 10-11, the rupee ranged between somewhere close to 44, and the higher side it was around 47.75, roughly slightly less than 4 rupees kind of a range. But if you see the subsequent years, very interesting. FY 11-12, rupee ranged between roughly slightly less than 44 again, 43.80, 85 to somewhere around 54.30, a range of 10.5 rupees. That was the kind of volatility we saw in FY 11-12. And in the just concluded financial year, the range has been roughly around 7 rupees, from around 50.50 to around 57, 30, 35, whatever you take, roughly. I just have rough figures. So you can see we are living definitely in an era of volatility, and all of us, whether we be a bank or whether we a company who has foreign exchange exposures, have to live in this and manage the risks which emanate from this volatility. From the banker's perspective, what does volatility imply? See, of course, volatility over a period of time is okay, but very often you see there is a lot of intraday volatility. Now, what does it imply? Why does it happen? What does intraday volatility indicate? Most often, intraday volatility indicates low liquidity. Most often, or it could indicate one-way market. There's either a lot of demand or there's a lot of supply, and so in a volatile market, normally you would see bid-offer spreads are much wider. That is because a market maker, like a bank or any other market maker, any market, finds it very difficult to execute any size of transaction. If the market gets hit on one side with a transaction, to defease the transaction in market takes long, and the risk carried by the market maker is large. So volatility is not only bad for entities having exposures in that asset class, whether it be foreign exchange or any other asset class, it's also extremely bad for a market maker who is operating in the market. Now, specifically to the dollar rupee, why is there so much of volatility, especially intraday volatility? As Mr. Patwardhan has said, and as we all know, the Indian rupee is not fully convertible. it is free to a certain limited extent. And there is a lot of restrictions on the kind of transactions that participants in the market can do. So obviously it's not as liquid as the more convertible currencies. And at other points in time, because the requirements of the economy, requirements of financial stability, additional restrictions could be imposed on the market. That makes it even more illiquid. In fact, in the past, when there were severe restrictions, by experience I know, market makers have found it very difficult even to defease or cover a position of around just $10 to $20 million. It's hardly anything in this market, in the size of this market, but restrictions make the market that much illiquid. And as restrictions move away, as we have seen in the recent lifting of restrictions on overnight positions of market makers, liquidity has improved significantly. So the message is, yes, markets are volatile, likely to be volatile, not only over a longer period of time, they will continue to be volatile even on an intraday basis, because liquidity at various points in time is likely to be limited. So what does one do in this market? And we did an internal study analysis of the markets over the last dollar rupee market over the last 10 years. And what we came up with was that for most years over the last 10 years, if entities having foreign exchange exposure, whether they be exporters or importers, receivables or payables, if they had hedged, they would have been better off than carrying an unhedged position for most of the period. There were a couple of years, obviously, and depending on which side you were, you would benefit by not hedging. But otherwise, you would have always benefited by having hedged your positions. And that's a lesson to there are years, yes, sometimes you will feel bad that, you have hedged, but, market, if you had not hedged, you would have been better off. But you would only come to know it post facto. But if you do an analysis, I think it's always better to be hedged. And I couldn't agree more with my co-panelists that, yes, entities having exposures in the market need to definitely have a risk management policy and a risk management hedging strategy, which needs to be consistently followed. Of course, there could be changes, tweaks to the strategy depending on market conditions, but on a broad basis, currency management strategy needs to be followed by entities having any significant exposure in the market. So these are the one or two brief points I had wanted to say. I wanted to cut it short here for paucity of time, and then I think I'll leave it to Venkat and maybe some questions thereafter. Thank you.
After listening to Ashish, I just remember, if I can modify the famous dialogue in award-winning movie, market तीनों चीज की वजह से चलती है, volatility, volatility, volatility. I think we just ran out of time, so if I can continue a tea break, I will take 300 seconds of questioning. Otherwise, if you all clap, then we will say the panel is closed. So thank you very much. You have been a very good audience post-lunch. I didn't see any of you dozing off. So, and the credit goes to the panelists. And thank you very much, panelists, for being a wonderful panelist today. Thank you.
Thank you very much to all the panelists over here. I would request now Mr. Ashokan, the co-chairman, Capital Market Committee, to present the mementos. Sir, if you can from here, please. I'd like to present to Mr. Patwardhan. Mr. Venkataraman. Mr. Tyagarajan. To Mr. Ashish Parthasarthi. To Mr. B.R. Jaju. Thank you very much. Thank you. Thank you. Thank you. We request for a group photograph, please. Sir, for a group photograph. Thank you. Thank you very much.